I think we'll get started. I want to be very respectful of everyone's time and start by welcoming you all. We're gonna spend the next hour and a half, or maybe a little less, with you. And the topic and focus today is our Women's Business Owner Symposium. And we're thrilled to have several guests with us today. We're going to do today's session in two parts. And we're going to open and focus with our first guest for the first, call it 45 minutes of today. Our guest is Alex Liebenthal from Houlihan Lokey. Alex, thank you and welcome.
You.
Just a few ground rules for today. And I think the important ground rule number one is that this is meant to be a discussion that focuses on your questions. We have some content that we think is very important that we wanted to convey to you, but we welcome questions. And the best way that we can approach a webinar like this is that we welcome you to add your questions to the Q&A button on your Zoom. And then we'll weave those questions in as often as possible during the conversation and address them whenever we can during the conversation or at the end. So with Alex, we're going to have a fireside chat for a while and talk through some events and some topics. And then we're going to welcome our partners in from Lippis Mathias, which is Charles Telford and Courtney Donahue, to talk about estate and taxation planning. So there'll be part two of our discussion, and we'll do that in about 45 minutes. So without further ado, I want to start by saying we really wanted to thank Lori Kami, great advisor here at LCK Wealth, for helping us put this together. And Alex, I know you're good friends with Lori, and I'm sure you'd maybe echo the same.
Yes, absolutely. With lunch in the middle of COVID this fall, we cooked up the idea that this was something that really needed to be communicated to female business owners. So definitely kudos to her for making this happen.
Awesome. And thank you again for joining, Lori. Thank you as always for your contribution for this. Alex, let's start with you for a moment here. I think with people that have known you more often from my industry necessarily than the small business owner from the financial side of things, can you maybe tell the viewers today a little bit about your story, sharing as much as you feel comfortable with?
Yes, absolutely. And let me just say, I'm so thrilled to be here and to be talking about this. It's something I wish that I had had myself 20 years ago when I first sold the company. So I grew up in a family with a municipal bond business that was started by my grandmother and grandfather in 1925. I like to say my grandmother was a female founder just 100 years too early. She was a remarkable woman. And growing up with your grandmother running a business and running a business on Wall Street, the old, if you can see it, you can be it. That was certainly something that happened to me. And I grew up really without thinking that any rules or limitations that women thought they had applied to me, which I think has been a great source of my success and development, but also my desire to be a spokesperson or to speak my experience and truth to other women. I joined the business a couple of years out of college. At the time my grandmother was working, she and I worked together when she was 23 and I was 91. She retired 2 years later. And I had a dad who was kind of larger than life. So if you grew up in the New York City area in the 70s, 80s, 90s, early 2000s, you heard my dad's voice on the radio all the time talking about municipal bonds. So this larger than life dad, I at age 31 become CEO, and for a while struggled with how I was supposed to fit into his shoes. And then I like to say I realized his wingtip shoes weren't the same as my Manolo Blahniks. But I think when you are in a family business and you're younger, it really takes time to figure out who you are and what your role is in the business. I ran it for 8 years, transformed it from just a muni firm into more of a full wealth management firm. And then in 2001, I sold the company. So 75-year-old family business, all of a sudden with a new owner. We sold to a regional brokerage firm, Advest, which was owned by Mutual of New York, which was then sold to AXA Financial, which then sold Liebenthal and Advest to Merrill Lynch. So this all happened in a 4-year period, kind of crazy if you can imagine. At the point of the final sale, I left and then restarted de novo without even my name, which I got back later, and we'll talk about that a bit during some of the things I recommend, but started and for 10 years ran a wealth and asset management firm that also was the #1 woman-owned firm in debt and equity capital markets. 2016, 17, a couple of big old bumps that happened, and that happens in business. And during that time of struggle, I realized, there's something else for me, and I'm not sure I want to keep being CEO of a company. So I left and started realizing that there were so many women looking for capital without real relationships in the investment banking community. And it just got me thinking that affects a woman's growth and scale of her business. And why aren't those relationships happening at the same rate and time that relationships with men are happening? And then I realized, and you know what? There are enough middle market, large, successful female-led businesses that it's really time for an investment bank to say, hey, this is an opportunity and we should be working with these women. We should be communicating to them. We should be thinking about how we build relationships with them. So I joined Houlihan Lokey in September as a senior advisor in the financial sponsors group to build this whole thing out. So, that feeling that there was something more for me, I'm just so grateful to say I was able to find.
And how's that engagement been so far? I mean, obviously you've had a chance to meet and now work with over that period of time a number of different, sounds like female-owned businesses and maybe even more. But how has that been so far for you?
So it's been fascinating, and I'll sort of break it down into three parts. First of all, most women, I would say I've not had one conversation with a woman where the response hasn't been, that is so cool, tell me more about it, and the appreciation that I have for being on their side of the table. There also is this wonderful aspect of talking to women who aren't necessarily ready to sell their company, but going back to what I was talking about before, who aren't developing those relationships. So I have as much joy in talking to a woman with $2 or $3 or $4 million in revenue and just kind of getting her started thinking on this journey as I do with a woman who has $100 million in revenues. The internal reaction from the bank has been absolutely fantastic. And I think it's really a sign of how far we have evolved as an industry. I feel like a decade ago, the reaction might have been, oh yeah, we do this woman's thing over there. It doesn't really involve us. But instead, the bankers from the beginning, the reaction was, this is great. How can we use you? Can you help us right now? We're working with a female founder. And they're really excited and recognize that they actually feel a little bit awkward to be all white men on one side of the table when they see a woman or a diverse management team on the other side of the table. And then the last thing I'll say is from the sponsor community, from all of the private equity funds that we work with, they recognize the opportunity, they recognize the need to be more diverse internally, and are kind of really open to any opportunities and assistance in conversations that can help them get there as well.
You mentioned just a moment ago, you're just as interested in talking to someone with 2 or 3 or 4 million in revenue just getting started. I think the tail part of the discussion may be more for that $100 million deciding what the next steps are, but for that $2, $3, $4 million individual just getting started, thinking about the next steps, how do I grow my business? Can you just walk us through a little bit how you approach it with someone at that stage and kind of some guidance and thoughts you might be able to share?
Yeah, that's a great question. And I would say that female founders are very, very receptive to having that conversation. But look, when you're running your own company, and especially when it's a startup, you've got your head down all the time. So I think having those conversations where you're able to kind of have a broader conversation with someone who understands kind of what's involved and needed in the longer term development of your business is something that's really important. It's something I've seen those women really respond to. And then one of the things also is just, and I encourage, regardless, something I say to my 24-year-old daughter, talk to everyone. You never know where a conversation is going to lead, and one conversation leads to an introduction. So have conversations with lots of different people, and have conversations with people in the financial world. Use this time to kind of sop up whatever you can out there, because that's going to really be a part of kind of building that foundation and developing as you go.
So just as we think about now some later stages, we're going to continue to grow your business. There's a lot of folks in here who might not be in startup mode, but they certainly aren't in the mode of thinking about the idea of quote unquote selling your business. So there's that sort of middle ground. And I think there's a challenge with the word selling on this, because it infers that there's a sort of binary option. That's not typically the case. And can you kind of maybe walk through with folks when we talk about thinking about those next steps? It's not quite as black and white as you're selling or not selling a business.
Right. And, it's funny, Colin, I was thinking about this in getting ready for it. And obviously at Hightower, you're managing people's wealth. And it's very similar to thinking about how you're going to allocate your assets and invest your money. You think about what your long-term goals are, and kind of the rest sort of helps to back into what your outcome should be. So first of all, as I said, picking your head up and sort of looking further out. Do you want to pass this business on to your next generation? If so, are you going to need capital to do that? Do you want to sell at some point? Do you have an idea in your head of you kind of walking off into the sunset and going on a sailboat, never thinking about it again? Just sort of thinking about what do I look like all those years down the road? Because that's going to sort of like help set the stage for the type of person you might sell to. The other thing is also really understanding where you are in your own kind of life stage and age and desires. So when I sold the company to Advest, I was 37. I had a lot of energy. I was very strong in my beliefs about what I wanted the business to be. I will say that it probably would have been smarter, rather than selling to a strategic, to sell to a financial, to sell to a private equity company, so that I had the opportunity to still be an independent, if you will, CEO. So, for me at age 37, I wish I'd had time to understand that and think about that. If I were 75, or if, I just was just ready to leave, then that's a whole different thing. So right. I think, again, kind of thinking about what your goals are. Maybe those are the shorter term goals. But that's also really important. And, from ensuring you don't make those mistakes that people might have made. And I will just say on one other thing I was thinking about also. It's funny, again, sort of bringing up the money manager thing. We don't often talk to people about what our overall investments are, unless, we happen to buy Bitcoin at $4. But people should be encouraged to talk, or entrepreneurs to talk to other entrepreneurs who have gone through that process themselves. Maybe other entrepreneurs who actually have sold to the type of entity that you ultimately might want to. But, hearing about that person's experience can be really, really valid and relevant for you as a CEO.
That's excellent. And, I kind of think back through, you talk about some of the different market cycles, where you are in your own sort of life cycle, business cycle, et cetera. Just kind of back to the planning aspect of this, there are so many more things that you can do than sell your business. And sometimes, to your point earlier, you mentioned growth capital that you need, you want to grow. Maybe you want to acquire a competitor. Maybe you're looking for an opportunity to just grow your presence in a marketplace and you need to proceed there. But there are so many other areas here, including, sort of looking at minority interests that you mentioned, finding a private equity sponsor to come in and look. They don't need to take a majority position necessarily. So, just can you talk a little bit about some of the options available? And we're going to go back to a key one here in just a moment or two, because there's a word that's kind of dominating the industry at the moment, but just some of those other traditional measures of some next steps and what they might look like.
Yes, definitely. This is so important, and I think this is an area that entrepreneurs don't often get this look inside, and yet I think it's also one of the really, really critical things to do, and something that they can do. So there is just a myriad of options in terms of acquirers or investors out there, both in terms of the type as well as the structure. So let's just take sort of the private equity world overall. There's private equity. That means they're buying either some or all of your company. So as I said before, with me at age 37 and having a lot of real strong opinions about what I wanted, it might have been best to go to a private equity firm that was going to do a minority interest. For someone else, it may be that because of the capital needed, and again, where they are in their stage, a majority interest. It may be 100% of their company. It may be 70% of the company, but a point where that private equity fund is going to essentially be in control of your business. There are ways to structure, whether it's debt, whether it's equity, there's a whole world of structuring. And I will say, because obviously we have women listening to this today, and there may be women who depend on their female-owned designation, usually WeBank, for part of their business. And so that is something that's obviously really critical. If you have to have control of your business and a controlling ownership, then you're going to want to make sure that whoever you sell to is going to be able to structure the deal that way so that you can continue on with your designation. The last thing I will say in the whole private equity arena is they're finding the right. It's kind of like finding a match. Finding the right type is really important as well. We all think private equity, and we tend to think of the Blackstones and KKRs of the world. I mean, that's one whole area of private equity. And then there is this whole fascinating world of private equity companies that are middle market, lower middle market. That's a really broad term. Everybody can say they're middle market. It may mean a lot of different things, but there may be some that really love working with founders. They love being that first institutional check. So that might be the right option for you. But really kind of understanding, and this is something that your banker really is supposed to help you do, is understanding that whole arena out there. And before you even jump in, is kind of having a sense of okay, I think this actually is the right type of private equity sponsor that's going to make sense for me.
This is the first time I'm going to paraphrase something we've probably said about 12 times in our prep call, but it's never too early to have those conversations at this point. And, back to the planning aspect of this, but, we did say that we're going to bring that in when we talk to Courtney and Charles in a little while too, about never too early to plan. But just emphasizing that over and over and over again, you mentioned having these conversations earlier, just kind of understanding where you are, your industry, the resources around you. Does all that kind of fit together? The idea of just being kind of open-minded and thinking through all the outcomes, would that be a good way to approach this?
Yes. Again, I think always having conversations. So what's out there, the competitive landscape, whether it's private equity funds, whether it's even venture capital funds, they want to know who's out there who might be on their list to acquire. They recognize that having conversations earlier is really important for them in ensuring that they're the ones ultimately, if they have their eye on you, are going to get the transaction. Having a banker, having conversations with bankers early on. I mean, one of our bankers says, who specializes in health and wellness, she says, if you want to sell your business to Unilever, you can't meet me 6 months before. I want to meet you 3, 4, 5 years before, because I know what Unilever looks like. I know the type of things that you're going to want to do in terms of your business. So understanding, and I know you guys are going to talk about this later in terms of the team, understanding that all these people out there are a part of your team in understanding the process, and potentially some of them your team actually as you do go through the process. And I would say, as a woman, don't be shy. If somebody doesn't want to take the time for you now, they're not going to be the right person for you later on. Because they will only have kind of thought when the dollar signs, go ka-ching, that it's time to pay attention to you. And there are way too many people out there who want to be able to spend the time with you now.
I'm going to suggest we're going to keep going on this topic. I want to come back to that crazy word in a moment that everyone will define and kind of talk about here. But you were just kind of taking us through some of these questions, things to ask. Even if you're just being, again, open-minded and you're in that growth stage and you're not quite thinking about the exit, can you talk about some things that are really important to make sure buttoned up in that process long before we approach this? And I'll even take a moment, even just to say, I'll just echo something you said a moment ago. Having a conversation with an investment bank, and anyone from Hightower, can work with my team and help you get in touch with Alex's group at Houlihan and other banks certainly we have in our network. That does not in any way put you in an obligation to make an action going forward. It's a conversation, to Alex's point. So I just wanted to clarify that. You certainly can go down that road and have these preliminary conversations and just get the information you're looking for, with certainly no expectation from anybody that you're going to do anything coming out of there other than no more than when you started, right? So
Absolutely.
Yeah. So back to the question just before, what some of those things you can start doing to prepare for the quality of what you'd be looking for maybe in an event in the future.
Yeah. So first of all, something that is incredibly important, one of the things that I wish I had had, is ensuring that you are doing everything you can to kind of get the way you present your financials in shape, so that when you get to the point of working with a banker, when you get to the point of due diligence, when you have your acquirer, it's not kind of saying, oh, this is the way I've always taken notes, you guys transcribe it. Look, I know this from my own past, you know the way that you like to see your financials, your numbers, what you're measuring. It's your way of doing it. And it's right for you at the time. But the reality is that buyers and bankers are going to want to see numbers presented in a certain way. So there are people, we do it. There are also people whose their whole kind of business is consulting and working with CEOs for a couple of years, kind of help them get in shape for seller readiness, as we call it. So I think that is just one of the most important things, because ultimately it's not just about, it being sort of difficult to get through materials and due diligence. It can actually make a huge difference in the valuation of your company, to ensure that you have somebody who knows what that's supposed to look like. So I would say that is incredibly important. And then just going back to banking for a second, ensuring that the banks you're going to talk to are the right ones. If you are a $20 million business, Goldman Sachs is not going to be the right banker for you. Their deals are going to be too large. They will tell you that. If you are going to be selling, a company, consumer products company, a bank that has more of a tech focus probably isn't going to be the right bank for you. So really finding that right one, because that will ensure that they understand the intricacies of your business that are important to the valuation of it, so that ultimately they're going to be able to say to the buyers, this is why this business is worth, X more than you're willing to pay for it right now. Having the right match is just so important.
I'm just going to add for, Alex is talking about diversification of banks, thinking about different types of banks of sizes and different verticals and things of that nature. If you're listening to this and you want to know more about that, talk to your Hightower advisor after the call today. We have a network of banks, which obviously Houlihan Lokey is a huge part of, but other folks that have smaller and different geographies, different verticals, different things. So certainly we've done that to try to make so there's a match for you to have that conversation that Alex was talking about. I think it's time to talk about SPACs. And it's almost impossible to stay away from this, because every time you pick up the Wall Street Journal or Barron's or Fortune or even Google Finance, we're talking about this incredibly hot M&A market where things are going for, incredible valuations, and these SPACs are just everywhere and buying everything they can. Let's start with what a SPAC is and how it might factor into the market that we're looking at, Alex.
Right. And I'm so glad we're talking about this sort of, as it relates to company owners. So a SPAC basically is a couple of people, group of people who have expertise in a particular area saying, hey, investing public, we want to raise $300 million in an IPO. We're not going to tell you what we're going to buy with it. It's going to take us anywhere from 18 to 24 months to find the company that we're going to want to buy. So you should trust us because we've got this great experience. And ultimately, if you don't like what we've bought, you don't even have to keep your money in it. So that's kind of a really sort of, very, very basic description. But basically it is a way for a company that is private to go public without having to go through an IPO on their own. It's been around, they've been around forever. They've been around for probably 25 or more years. And it's been in the last 18 months that all of a sudden it has exploded to the point where there are now over 400 SPACs looking for companies to acquire, or actually technically to have you merge into.
So a couple things come to mind. It's been around for 25 years, but I think that this explosion of SPACs prompts a couple of things that we can go a little further with. Number one, it speaks to the market, with the market being this incredibly, sort of hot, if you will. And two, maybe back to exploring and having conversations, you may get a call. You may be someone on this, webinar, and you may get a call now or in 6 months or in who knows how much time. And before you do much after that, Alex, should I suggest maybe picking up the phone and calling your team to say, I got this call, what should I do with this?
Yes, absolutely. So, I started, when you're in your own industry and business and everybody's talking their own, using their own language that we speak in terms of SPACs. And then one day I was talking to a woman and she said, yeah, I gotten calls from all these SPACs and they're telling me that this is the greatest thing ever. And I don't even understand what it is. And I'm not even sure I like these guys to begin with. And all of a sudden it was like this, apple hit me on the head. And I thought, wow, this is an incredibly important financing vehicle, very appropriate and relevant for some and entirely not for others. So if you are, Josephine, company owner, how do you know whether it's the right SPAC for you, whether the SPAC is right for you at all? And, sort of what you then do from there. So I'm just really concerned about all of these company owners out there that are fielding and going to continue to field calls left and right. And I will say, I mentioned before, this 18 to 24 months. So some SPACs have 18 months to find a target, others have 24 months. And at that point, if they don't find a target, everyone gets their money back. So I have a little bit of concern about, 12 to 18 months from now, as a lot of SPACs have not found targets, what that sort of frenzied level of activity might be in trying to find the right target. So, I think that description of that one call that my friend got will probably be amplified as in the coming months.
And I just might tell everybody in the webinar, don't judge a SPAC by how many home runs the individual who's sponsoring it has hit, or how many songs they have on the Grammy list, or movies they've been a part of, because that seems to be the trend today.
Yes, in fact, and there certainly are those cases, and I think as time goes on, we're going to see less of those. Here's, to me, what the most important thing is in talking to a SPAC. Does the team really understand your particular sector? If they're sort of generalists, or they figure, hey, there's opportunity in tech, probably not the right one. Does the team have operating experience? And does the team have enough kind of financing, private equity experience, public company experience, that they're really going to be able to shepherd this process all the way through? And so as you said, yes, there are many sort of golden glittering ones out there, and then there's some that may seem really boring, and they may actually be the perfect one.
Right. There's a question that came in that is probably relevant for now, and I'll just remind everybody, you're welcome to send questions. We'll do an open Q&A in a few minutes, but send your questions now and we'll queue them up and ready to ask you in just a few more points here to make. The first question says, can you talk about key drivers that business owners should focus on to maximize value when exiting or going through a sale? Ideas like growth, team, operations, other. We heard earlier, we talked about having sort of quality earnings and a consistent sort of audited report, but maybe some other items that would fit that bill that you might give as suggestions.
I'm not actually, could you ask, I'm not completely following the question. I'm sorry.
So what other items, what other steps would a business owner focus on to start to think about maximization of their sale value? So obviously, like we said, consistent earnings, but some other things they can do. You mentioned about how much should they be growing? Do they need a robust team? Things of that nature, maybe.
Yes, so actually great. That's a great question. So the team certainly is important. There are times when a company is going to go public, is in the process of going public, and they'll hire a CFO who has public company experience because that's super important to going through that whole process. That may not be the case for everyone, but again, having a team that has participated in other companies that have gone through significant growth and that even have just gone through sales in the past. I will say for me, that was an incredibly important thing. I had hired a man who'd been on Wall Street for a lot longer than I had been and understood, a lot more about sort of the bigger picture than I did. Your kind of products and lines of business are really important. Obviously we're all as business owners want to be able to be as successful in every area, but thinking out longer term, if there's one area or product that it's been a baby of yours, you've loved trying to build it, but ultimately it may not be the right thing, sort of A, think about whether that's relevant, or B, even is that something that should be put into a separate entity. We were having a discussion the other day with a woman there's one part of her business she sees as the huge growth opportunity. It's much smaller, and so she's separated that. I think also, and this goes to the kind of getting your numbers in shape, but really being able to talk about your revenues, your customer acquisition, your cost of goods, in a way that somebody will be able to see at the end and really see the value, but also you'll be able to really measure how your business is performing. And again, that's something that we do. And again, something I wish I had. I was thinking back to the days when I was trying to explain to my dad why we shouldn't be advertising as much. And this analysis I'd done by hand. Now in a family business, you can do all the analysis you want, and that may not ultimately be successful, but that's super important. And then I also think, and this is maybe kind of quasi in the longer term planning process, but thinking about what's really important to you, so that when you get to the point of negotiating and selling, you'll be able to say to your banker, like, hey, you know what? I really want the option to get my name back if it doesn't work out. I really want to make sure that XYZ family members are taken care of after the sale. There are a lot of really little things that you can do. So kind of thinking about that in the planning process, I think is very important.
Now, you just said that well. I'm going to summarize a couple of the points, which I hope help sort of drive this forward a little bit. But the ability to understand and communicate your business, and being able to do that and understanding exactly what makes you kind of special. And two, this is something we talk about all the time. It's consistent and reliable growth. And certainly there's opportunities for massive growth. A lot of folks have seen that in the COVID era, right? They've had something that happened that was, spurred them to abnormal growth for a year. But sometimes in the process, that is not going to drive the sale price so much higher because it doesn't prove you can keep doing that in the future. So just adding a little bit here. I know we've got another question or two coming in here, so I'll answer that in just a moment with you. I want to talk about one thing though. You touched on this about something that you maybe wish you had thought about at 31, But there's the whole behavioral aspect, the mental and psychological aspect of losing control, selling a part of your business, no longer making all the decisions yourself, or even completely walking away. Just want to talk a little bit about some of those things and when to start thinking about that in this process.
Yeah. It's funny, of all the business aspects, the planning, the numbers, it's the most important thing. It's the toughest thing. There ultimately is, you're not quite sure how you really will react on the other side. I think that probably more often than not, people will go through the experience that I went through, which is huge excitement about the sale, the realization of all the efforts of your family over all these years. And then a few months in, just feeling this really tough kind of sadness and finally going, they gave me that check because I gave up control. And that's a really tough thing to come to terms with. Emotionally, it can be a really tough thing when it comes to not necessarily taking care of your employees financially, but not being the one in charge fully of your employees going forward. It may be that the way you've thought about your brand is very specific to you and your own vision, and your buyer may have completely different ideas about what brand is. So again, I would say talking to other people who have gone through it is really important. And I would say, that's something that anybody, I would love to pick up the phone and just talk about that, even outside of, hey, I need a banker, just kind of walking through those steps. Because it's going to happen in some way, shape, or form regardless. And, for those people who've spent their whole lives building this business and think it's going to be great, I'm going to play golf, I'm going to go on my boat, I think there still is that same aspect. And again, that I think does also drive who your buyer ultimately should be. But the last thing I will say, and this also fits very much into why I'm doing what I'm doing and why I'm so passionate about it, is that you're going to be sitting with bankers and private equity funds and strategic buyers, and it's going to be a business transaction. Yeah, they're going to be excited. They're going to love you. They're going to love your business. It's a business transaction. And for you, it is emotional. And so having someone on your team who knows what it's like to work with founders, and there are a lot of bankers that know that, but who can see you in a meeting and realize this is a little tough for her. Let's just kind of take a step back and kind of walk her through, okay, I get what's happening, or when there are moments of crisis in a deal, which invariably are going to happen, where, you may be completely emotional and your bankers may not be as emotional. Just being very, very aware of that and ensuring that you have partners who are going to help you through that process.
A team approach. We're going to go there in a moment. Yes. That's for sure. It's very well said. I'm going to do another question came in, and if you have another question or two, fire them away now, because we've got about 5 minutes before we pivot and transition over. Questions a bit on family offices, and it says, have you seen family offices becoming more active as buyers? And how should a seller think about selling to a family office versus, say, a PE firm?
That's a great question and a really kind of bigger topic, because, and Colin, you can certainly attest to this, over the last, I don't know, 10 years, 15 years, maybe more, family offices kind of, it's like the Hollywood sign.
Like
all of a sudden, it's like, with blinking lights, and everybody talks about family offices, and there are a lot of people looking to raise capital for companies, for individual investments, for funds, that all think, if I could just get to the family offices, then I'll have all the money that I need. And family offices are very, very different. They are reflective of the families and their histories themselves. So there may be in some family offices that were started by guys who made a cajillion dollars trading equities on Wall Street. Their family offices are going to tend to be more in the kind of equity investing, quantitative type world. There are family offices from families that had manufacturing businesses, that had consumer products businesses, they're the ones who are going to more likely be interested in acquiring businesses. One of the big differences I would say that's important to think about is that when you sell to a private equity fund, generally that fund is going to have a specific time period over which they will buy your company, help build it, and then sell it. And that's something they need to do. That's part of what their own investors expect. When it's a family office investor, they don't have a time horizon. So that might be the right approach for you relative to what your long-term needs and goals are. At the end of the day, it's still also going to be about the people. Do you like them? Do you feel comfortable with them? What other types of transactions have they done either in your area overall, or have they acquired other businesses? How have those situations gone? And I think always, finding out what are the ones that didn't go so well, because that may be an important lesson. But the family, just to sort of summarize, it's finding that specific family office that has an interest in acquiring businesses in your particular sector.
Great. Yeah. Family office is the SPAC in terminology of that entire world at this point.
Right.
I've got one more that came in. So this is again about family offices. Interesting. What trends are you seeing in succession planning with family offices?
So I'm probably not the best person to comment on that, and hopefully Courtney or Charles can, but I will say, just from not from sort of the overall financial aspect, you do have a lot of family offices that, look, it's obviously family, it's intergenerational. And the daughters of those next generations are very interested in ultimately being involved, and not just sort of as what's been typical in the past as being the philanthropic arm, running the foundation. But there are women, and they're younger women, who say, no, you know what, we should be investing in women. We should be investing in female-led funds. We should be investing in female-led companies. So I do think that is a really important trend. And I think it's one that's going to continue also as a lot of men kind of get beyond I have daughters, which is a pet peeve of mine too. I have daughters, and therefore, here's what we are going to do. Here's what we're doing with my daughter. So I think that's going to be an interesting thing to follow.
Well, I'm going to leave it. I know Charles and Courtney, we're going to pivot here to bring you in here in a moment. And so, just thinking about, we talked about this team quite a bit, and this is a great segue over to talk about other members of the team. When you do start to think about how to prepare for those next steps, we talked about a lot of conversations. We think, the financial advisor is a good person to bring onto the team, the investment banker. We're going to talk to our trust and estate, team members in a moment. Who else might be on that team, Alex, in your opinion, as we want to start to have these group conversations?
So, financial advisor, accountant, banker, attorney, deal attorney,
M&A attorney,
right, M&A attorney, as well as estate planning attorney, which are two obviously entirely different things, but a lot of times people don't necessarily recognize that. And I just want to go back to financial advisor for a second, because you might think, well, they handle my investments now and they'll handle the investments after, but they are really integral to this process, because they're the ones who've helped manage the assets that you do have. And all of a sudden, you are going to have a pile of money. It may be a pile of stock, it may be a pile of cash, it may be both. But for them to understand what that may look like, so that they can really be thinking about that, and they can use their own internal team to ensure that all of a sudden that pile of money, they know what they should be doing, and they also know how to interact with the rest of the team. And I'll just say one more thing, and I think is super important, is that your team should all be focused on one thing, which is you. So interact actions, political stuff, strains, whatever amongst the team members, like no time for that. You got to all be on team, team client.
Excellent. That's a great segue now. So Charles, Courtney, would you mind coming off mute and joining us? Thank you and welcome to both of you. We appreciate your time.
Thank you.
Yes, great to be here.
So,
Colin, if I could just jump in for 1 second and maybe build on some of the things that Alex said, which I thought was terrific, is that not to sound like a broken record, but it's never, ever too early for any business owner to be thinking about what the exit strategy is going to be for the business. And when you're thinking about selling a business and you're looking at a business, every business has flaws, every business has defects, every business has baggage, okay? And you don't want those flaws and defects and baggage to be identified for the first time when the person or thing that you think is your buyer is in the middle of doing its due diligence. I suppose in the ideal situation, we get to work with the business owner and we may be able to say to them, well, if you're thinking about selling 3 to 5 years out and you're willing to make the commitment and you want to spend the money predominantly on legal fees and accounting, one of the better things you can do is to go through a real honest to goodness pro forma exercise in terms of let's pretend that we're selling your business today. And let's look at your financials and let's look at everything else and let's really turn it upside down and shake it and see what falls out. And let's find out where the warts, the thorns, the problems are now and how that affects the sale of the business. And that'll do a lot of different things. Clearly, if you fix those problems, it's going to enhance the value that you can sell the business for. But you may find out sometimes too that some of those flaws and things are so fundamental that without fixing them, you actually can't even sell the business right now. Maybe you can't afford to sell the business or there are other issues. You could find that you have a business, let's say one that's heavily valued and dependent upon having franchises or licenses or IP, and find out, oh my gosh, there's 2 years left on that license or that deal or otherwise. What I thought was there in terms of value or otherwise doesn't exist. So really, you can never start early enough to be looking at those things because you don't want the ghost to pop out from behind the door after you've started down the honest to goodness process of trying to sell.
I think that's great advice. And the practice run to do that, you have to be open and willing to accept the honesty that comes with that you're willing to fix those things, Charles. So I think that's very well said.
Well, I'm really a janitor. I'm not a lawyer. So
well, for the recording today, we'll have to make sure we caption that and say, no, really is a lawyer at the bottom before we release this. What we're going to do for our format here is Alex is going to stay with us. We're going to keep our team approach. So we have obviously from the trust and estate side two great attorneys with us. Alex will represent the banking side. And I'm happy to sort of on the wealth management side for questions as they come up. And we'll just sort of dialogue here. So questions, you're welcome to ask them on any of these fronts. And we're going to address this as a team sort of atmosphere if you do want to send some items in Q&A. Let's focus though a bit more on the trust and estate side. And so we talked about maybe some of those warts that could come up and be a challenge, whether it's for the idea of a sale or just, oops, why was this set up this way? And we've seen this a few times now, especially with businesses that were set up as an S Corp or a C Corp or, an LLC or LP that maybe shouldn't have been. And so, Charles or Courtney, I'll ask you this. Is this, something that you review often with clients? I know there are other divisions of the firm that may handle more of this work specifically, but have you been through this and have you seen situations and how important can it be to get that right?
I wouldn't say that it comes up absent a change agent like someone thinking about selling a business or some unfortunate occurrence like a death or a divorce or something like that. But very frequently in the estate planning context, we get people who come to us with various types of businesses who have preordained notions about what they want to do or how they want to do it or how they think things are going to work. And it's very, very common with a closely held business that success, I guess to some extent, breeds complacency in terms of what people have as a real understanding of what they own and how they own it and what it does. And many times we have to take a couple steps backwards before we can go forward to make sure that we're on a solid foundation. And that means we basically do a forensic of all the underlying operating documents, bylaws, certificate of incorporation, operating agreement, whatever the business entity is. And you very frequently find that the way the business is being run versus the way the business ought to be run are two different things. You even run into situations where you say, I'd like to see a cap table for your business. I'd like to see what you think you own and how you think you own it. And once you get past the fact of explaining what a cap table is, and then maybe you get the accountant involved, again, very, very frequently do you find out that what the person actually owns versus what they think they own are two dramatically different things. And you often run into situations where a business owner thinks they have the right to sell a business or to transfer a business at death unilaterally. And you find that when you look at the underlying documents, there's restrictions in an operating agreement or a shareholders agreement or a licensing agreement, et cetera. There tends to be, when things are done the right way and people are clear-headed, a lot of background work to get on a solid platform before you could even think about going forward with the estate planning piece.
And just to piggyback off of that and kind of incorporates a lot of what Alex said, when we're looking at an estate plan for someone, not even just selling a business or transitioning a business, there's a lot of homework involved, because part of our job is learning about you and learning about your goals for your family, your goals for your assets, your goals for your business. And that's where the team approach comes in. Alex mentioned your financial advisor has been with you all along. They're going to be able to give us the background. Or your CPA, why did they, form a C Corp instead of call a corporate attorney to consult. And so a lot of what we're doing in the beginning stages is putting this team together, even from an estate planning standpoint, which will hopefully segue and get business owners in the right mindset to be able to have future conversations about succession planning, whether it's a sale or next generation.
Yeah, another thing too is, like a lot of lawyers, I was a history major in college, and I don't think I ever took any kind of a course having to deal with psychology or otherwise. And I find myself 35 years later practicing psychiatry without a license every day. And there is a lot of emotional aspects that Alex mentioned in connection with these things, about getting people to understand estate planning and what the transition of their business really means, identifying the people to whom they can transition it. Do they have family members, or do they not have family members? And are they being honest with themselves about, if it is a family member, is the person who they've pegged really capable of running a business, or is it just because they happen to be related by blood or marriage to someone? And the truth of the matter is, that's the last thing that they want to do. So that's yet another aspect of it.
Yeah, are they capable, and do they want to? Right, because
Mm-hmm.
there's
Correct.
That's a huge
two dramatically different things.
Mm-hmm.
Yeah, we've got some questions coming, which is great. So we're going to tee some of those up here in a moment. But there was a few things. Maybe Courtney, you touched on this a moment ago, and I just kind of want to rethink this through. There's a lot of growing businesses. We talked about the phases of business and folks who might have started a company and gotten an estate plan done when it was not much about the company, but much more about liquid net worth and homes and assets and things of that nature. And now this company is a much bigger part of the plan. And the question becomes, how often should they revisit this with attorneys like yourselves and sort of evaluating the estate side of things, because things do change. And we'll talk a little bit about the near future, but as of even now, things have changed over the last few years based on the size of your company.
That's a very good elementary estate planning question. And a while back, I read something from the New York State Bar that the rule of thumb is every 3 to 5 years, that kind of range. Pull your documents out, look at them. Specifically, business owners, a business evaluation. You, as Charles mentioned, you might just be chugging along and not even be looking at some of your underlying documents. And so just because every 3 to 5 years you look at them, you might call your attorney and we review things and review your plan, your assets are changing. The laws are changing. Your family is changing. And being open-minded to having the conversation with your trusted professionals, whether it's an accountant or an attorney, and being able to have that reflective conversation to say, I need to spend the money to do a consult, even if that means I might not be able to, or I'm not changing the document, or maybe I'm not changing some of the documents, but I'm having a broader conversation that I didn't need a few years ago. So I do think a 3 to 5 year window, which to a business owner, they probably say, I don't have time every 3 years to look at my estate planning documents, but give it some thought then. Just reflect on it, and call us if you have questions. But that's what I would say. Charles, do you kind of agree with that timeline?
Well, I don't think there's any definitive answer to that or magical answer to it. Most of the time it falls into different categories of things that prompts that. There are change agents. There are good things to happen with people. There's the birth of a child. There's a marriage. There's bad things. There's divorces. There's disability. There's other issues. Changes in the law are very frequent. And then there are other things too that the clients wouldn't be aware of because they don't do what we do. There could be a different technique that's available to do something that wasn't available or wasn't widely known or widely accepted or perhaps tested by the tax court or otherwise, that now is a proven model for purposes of doing something. So one of the nice things about having a team of people to work with is everybody comes at these things from different directions. And if you have a group of people all looking at these things all the time, and they're always in place, and they're always there to sort of police it and monitor it, there's a pretty good chance that if one of the things that's a good change agent that we should prompt looking at something, that'll cause either one of the people on the team to kick the client and say, you've got to come in and do something, or perhaps the client themselves. But those are the things that happen most frequently.
And really, Charles and I have been in meetings where clients come in and they say, well, I want to update my will, or I want to update my revocable trust. And to Charles's earlier point, we say, okay, we want to list to your current assets. Well, my business is fine. I have an operating agreement. We want to look at it. We can't give you advice in a vacuum. I can't legally, malpractice update your will, not knowing that what you think you have in your document. And so a lot of the looking at your documents is you have to look at everything, and you have to be ready to look at everything, whether it's because some triggering event like a divorce or a birth, or it's really just because some time has passed and you really just need to reflect and refresh.
It's also not unusual that clients come to us and they think that they came to us because of problem A, whatever problem A is. And if we can get them engaged and we can get them talking long enough and we can get enough information, we can end up saying, well, that is true. There is a problem A and it probably ought to be addressed. But the fact of the matter is, now that you've told me the whole scale of everything that's going on, you actually have problems B and C, which are orders of magnitude much more important and should be addressed sooner than problem A. So that happens quite a bit as well.
Talked about some of those sort of change catalysts that might go through. And Alex, I'm going to bring you in on this one. Something that we've made a clear focus at Hightower about 1.5 years ago was focusing on offering, cursory valuation for business owners to look at the value of their business. And, part of, you mentioned earlier, get informed, right? Have the conversations, get the information you can get. Part of that, we think, is understand your business value, because that could trigger a whole bunch of these discussions or revisit with Charles and Courtney, and really just maybe escalating you up, in decision trees. So do you agree that that might be something worth going through as an exercise, or no?
I 100% do. It's obviously meaningful for estate planning, but yeah, for kind of getting your mindset about whether it's worth more than you think it is or less than you think it is, and what that means for you and your goals. It's something that we do all the time. It's something that actually we had done with our family business. in estate planning for my grandmother. It happens with divorces. I've seen that a number of times as well, and it's really, really important. But I would absolutely say that's a critical thing.
And to Charles and Courtney's point, in terms of we've seen, we've already done that, as a financial advisor, putting that hat on for a moment, we get that often too. We've already been through our plan. We've already given you the docs. We've already reviewed the policy. A lot of times it's ripe for review for a lot of reasons. And we think business valuation could be a catalyst there too, just to go with the points you said earlier.
Can I just jump in on one more thing that Charles said that sort of fits into this and it really resonated with me, is that being prepared to show everything. Your advisors can't help you if they don't know everything. And you mentioned operating agreements that may have limitations, but your bank agreements can absolutely have limitations. So being prepared to do all of that, but also, Charles, what you said before about every business has flaws. So yes, there's going to be stuff that somebody else would have done differently, but just being sort of open and ready to have those conversations. And, look, you've done the best you can building this business. Not everything's going to be right. Nothing ever is. So, not sort of going into it feeling like, oh God, I don't want them to see under the hood or what I put in the closet before they came over.
Yeah, and there's simple things sometimes that come up too, that once we see everything, and we might find a situation where a business owner is a guarantor for a debt, and it's been years since anyone looked at it, and no one's given any thought to the fact that death is an event of acceleration, or maybe even disability, or change of control, are all going to be events of acceleration. And the fact of the matter, and banks never give up guarantees if they don't have to, and they're not going to volunteer it because they don't, just the way it works. But it may very well be that given changed circumstances, that you could go and knock on the banker's door and they'd say, oh gosh, yeah, we don't need that guarantee anymore, or we can replace it or do something else in lieu of it. And that puts a whole different spin on things in terms of the latitude that you have for purposes of planning with respect to the business. On the other end of the equation, if you are going to be involved with banking and borrowing with the business, it's good to try to build into those loan documents the latitude to allow you to make a transfer of the underlying equity, whatever that is, without it causing an event of acceleration. And one of the more common ones is, however you want to define it, for estate planning purposes. Maybe estate planning purposes says it's a trust set up for the owner's family or something like that. But you have to think of those things up front because, again, I don't want to pick on bankers. I suppose there's bankers who are on the call. No one volunteers those things. You have to ask for them. And if you don't know to ask for them, you won't.
So I love this question because everyone's touched on it. And it, personally, as someone who's involved in helping clients go through transactions, this is something we see all the time. So the question talks about many small and medium-sized business owners have grown with a attorney, a generalist attorney, or a generalist CPA, someone that's a friend almost in some ways that's been a part of the growth of the business. And, the question really says at the end of the day, the conversation might need to be had that there needs to be a specialist brought in, a specialist from the CPA side of things, specialist attorneys, as we hear the two of you talk from this side, and then starting the conversation about upgrading their team. So if we're doing this early and we're going to find the warts, this could be one we've seen quite often because that doesn't necessarily, the output doesn't rise to the standards Alex mentioned earlier, and some of the specific things Charles and Courtney have been talking about the last few minutes. So why don't we start from the estate planning side, just having these conversations a little bit. I know you're a sort of full service firm, so you have folks that might solve multiple parts of this and how you might approach that with a client.
Yeah, so it's going to come down to the client, I think, and how that client gets to us. I sat in a meeting recently where the clients did all the hard work for us. They said, look, we've been using this local attorney. We realize this is out of their league. We're coming to see you, and that's that. I've also been in meetings where maybe we bring that attorney in, right? Because they have the knowledge and the background. The client does not want them to feel out of place. And us as a practitioner, you do have, your local attorney who does your basic will, your personal injury, your house closing, all that. that scares me, right? So all respect to that attorney, because I only do trust and estates, right? So I'd love to bring that person in, and I don't know how other practitioners feel, but you know, two attorneys instead of one around the table, that's not a problem. Two CPAs around the table instead of one, that's not a problem. And so I think, you know, you, Colin, as a financial advisor, a lot of the times, you know, you might be able to approach this subject with your clients that, you know, let's bring in additional team members, but it's really going to come down to the client accepting bringing different people on, I think, and where they are in their business and their mindset with that.
I would say that most of the business owners that I've been blessed with to deal with over the years, contrary to what the public maybe thinks about business owners, are good, hardworking, honest, and above all else, probably loyal people in terms of they're loyal to their long-term advisors. It happens all the time. And I've had difficult discussions with business owners because they've brought me in perhaps specifically for what they perceive to be as their estate planning situation. And as a consequence, in my fact gathering and due diligence, I've looked at a lot of things that I don't think the owner anticipated. And based upon my experience, I see things that I question, that I don't think are right or appropriate. Not because someone wanted to do something wrong or otherwise, but perhaps it's just beyond their depth. They don't know any better. And it needs to be fixed, and it needs to be better. And I have an ethical and a professional obligation when those things arise to say to the client, this is what I see, this is what I think the problem is, and I think that this is the degree of help that you ought to get. And if there's an accountant or a lawyer or whomever it is that's otherwise in the situation, and they themselves recognize that something is beyond their depth, then they themselves have a legal and an ethical obligation to tell the client that and to get appropriate advice. And the professional atmosphere that we find ourselves in now gets more difficult all the time because everything is more difficult and everything is more complicated than it ever was before. Years ago, when you were doing estate planning for people, the discussion was almost exclusively tax planning. Taxes were always the tail that wagged the dog in terms of what you did for purposes of an estate plan. But now, very commonly and probably almost all the time, asset protection planning is a very significant element of estate planning, and also a sale of a business or preparing for the sale of a business. And many of these things are the kinds of things that if you don't deal with them on a regular basis, you don't want to start just wading into those waters on your first 50 or 20 or 30 $1 million transaction. It's just not smart. It's not a comfortable place to be. So we see it all the time. It's difficult, but when it happens, you have an obligation to bring that to the attention of the client. And as Courtney said, ultimately the client is the boss and the client's going to dictate what you do. But I would say in most instances, they will follow your recommendations, and you try to teach people, or treat people rather, with dignity and respect when you have to disengage or diminish what their position is, because that's the right thing to do. It's the right thing by their advisors, and it's the right thing by the client.
I'll chime in half in the advisory and half kind of someone who's been working on deals recently in this. I mean, number one, yeah, the advisor and our Hightower advisors typically have great relationships with lots of centers of influence, right? From attorneys to CPAs, and often will engage with them deeply and working with the client. So I think there's a couple of pieces here. One is, it doesn't mean your personal attorney that Courtney was referring to has to be out forever. They just might not have the capability to produce what needs to be produced to help take this to the next level, and sort of survive the that dry run that we might put through. That is what we've seen is the biggest challenge to a number of deals we put through, is they start to go forward, and Alex said earlier that sort of quality of earnings, or the reports come through and their CPAs put them together and they're just not even close to what needs to happen. And that conversation, meaning they're not a CFO and they're not an outsourced CFO and they've not really ever done that work before. It doesn't mean they can't do your personal taxes again in a few years, right? When that change happens. So, just putting that hat back on for a moment, we just want to have this be as expedited, as clean of a process as possible, helping you get the best result. So the guidance that's given from everybody here is typically, how can we best help you get your desired result? And if that means you need to maybe upgrade the team, as the questioner said, that might have to happen, and we have to work on what's your best interest. I want to make sure we have, again, I'm looking at time and I want to be thoughtful and respectful. We will certainly be done on time, but there's a couple of questions we wanted to do and a few more in queue here. But I can't have a call now having folks from Trust and Estate on without at least delving a little bit into their, we did SPACs with Alex. We're going to talk potential tax changes with Courtney and Charles here for a little bit. And we don't expect you to grab the 8 ball here and tell us what's going to happen. But, folks are now going to potentially have a change catalyst to review those policies and whatnot, given, changes that we might be expecting here in the next, call it 12 months or so. What kind of conversations are you having with clients, and how might you have some of the viewers think about that change catalyst for them?
My crystal ball's in the shop, another blown tube, so it's hard.
Well, I was gonna jump in, and Charles, and say, don't call your trusted advisors on December 1st.
Yes. Exactly.
As far as the law itself is concerned, obviously there's a lot of different proposals and different things floating out there. If I had to make an educated guess, the things that seem to be coming up the most and getting the most traction, there's going to be a material change in the amount of the unified credit. What that's going to be, I don't know. I suppose one way to look at it is that if you look at the Bernie Sanders proposal, he's at $3.5 million. And if you said maybe Bernie's at the most extreme side of things, and I don't know that he is, then maybe that's the low or the high water mark, however you want to define it in terms of what the unified credit could turn out to be. The other thing that very clearly, and there's a lot more talk about this, is what's going to happen with stepped up basis or not. And quite frankly, I'm not sure that everyone who's talking about stepped up basis and the different proposals really understand what it is that they're talking about and what the implications would be. I've seen some proposals that simply say that they'll just get rid of stepped up basis and everything will be carried over basis and there won't be any immediate tax or realization event, to other proposals that seem to suggest that we'd be moving more towards the Canadian system, which is a capital gains tax at death rather than an estate tax, which are two different things, and that you'd have a tax that would in fact be treated as if it deemed sale at death, with the delta between your historic tax cost and the fair market value being subject to tax. As Courtney indicated, last year we had a lot of people for at least 6 months of the year who were in kind of a panic because they had it in their heads that however the election was going to turn out on January 1st, for whatever reason, despite our urging them to the contrary, the law was not going to change on January 1st or something like that. So everyone was trying to, or at least a lot of clients were trying to use up their remaining unified credit or a substantial portion of it by different types of irrevocable transactions, out of the fear that immediately into the coming year and a new administration, the unified credit was going to go up into the vapors and you would have foregone an opportunity. Probably something like that is going to happen again if there is a change in the unified credit. It's just a question of what the orders of magnitude are going to be. But I would strongly echo what Courtney says, which is if you're thinking about doing some planning, now is the time to start moving forward with it and defining what it is that you're trying to accomplish rather than waiting until the last minute. Because quite frankly, one of the things that will happen is the availability of professionals will be diminished because they're already involved in engagements. There's only so many hours in the day. And if you think you want your things done well, then you've got to give people time to do it the right way and deliberate about it. And last year, we got to the point with people where we said, sorry, we can't do your work this year because we just can't. You're going to have to go someplace else because we're fully subscribed, and that'll probably happen again.
And I think, part of that is getting your ducks in a row. If your estate planning attorney has a questionnaire or a client organizer to help you start putting your assets on paper and your goals on paper, that's helpful. Like everything else with these changes, the IRS, your local state taxing agencies, they have to work out the kinks and they have to figure out how it's going to work. We've internally been speaking a little bit about if they get rid of the step up in basis, from a policing standpoint, what does that look like for us, right? When we're doing estate and tax administration, we're looking for closing letters from the IRS. And so a lot of this is more being proactive. Reach out to your advisors, have them inform you of the secondary sources and the literature and the different CLEs we're sitting through, so that we can at least be mindful of potential changes and how it could affect you, and that when these changes actually do happen, you're ready to have the conversation with your advisors, and it's not the well, I called you on December 1st, we had a whole month to do it conversation. And I do apologize to Charles, because I was on maternity leave at the end of 2020.
Which I think you planned, by the way. I think that was all part of your evil plan.
Similar, don't deliver your tax docs to your CPA the week of April 15th as well. So appreciate it. It's interesting, Charles, you talked about, folks doing things at the end of last year. And one of the questions that came, it's sort of a two-part question, but there still are some level of discussion, although I hear the probability continuing to decrease regularly, of the idea of retroactivity on capital gains, and some rules that might come through. Are you, were you thinking that might play out in terms of retroactivity going back to Jan 1 of 2021?
Again, it's a crystal ball question, but I think it's very, very, very unlikely. It's just partially to Courtney's point, it's just too difficult to police. It would be an accounting nightmare. I don't see that happening.
Yeah. Part two of the questions, just again, not looking for crystal ball, but just maybe gut feelings things here. We do a number of 1031 exchanges. Do you see that as being something that likely to be overturned, or something to continue with most policies you've seen?
Well, I'm aware that there's been talk about getting rid of it. I don't know. That one is kind of a real outlier. I think that probably the resolution of that will probably depend upon how strong the lobbyists are in Washington. And I suspect, like the insurance industry, there's a lot of very strong lobbyists in Washington in favor of 1031 transactions, which makes me think it's unlikely to go away. Maybe it will be changed in some fashion, but I think it's very unlikely that they would get rid of it. It's been in the tax code for so long. There's a lot of industry that's developed around 1031s, including there are funds now. A lot of people aren't aware of the fact that there are funds now that you can get into where you sell a business and you can go into a 1031 fund and defer your gain. Delaware statutory trusts, all sorts of different things that are dependent upon the existence of 1031 that I just think it's unlikely that they would get rid of it entirely, but you never know. It's possible. I think, Alex, you being in New York and the real estate market being what it is there, it would be interesting to know what your perspective is on that.
I'm not sure I can talk intelligently or specifically to it. Obviously, the real estate market in New York has been up and down and now up again. But I did just something you said resonated with me. Which is the sort of 1031 type exchange for business sales. And that is something that we did do because part of our transaction was in publicly traded stocks. So we did do an exchange fund, which had some benefits for a time and then ultimately did not. But I mean, that's something very, very important to consider. Minimizing your tax gains, obviously.
Yeah.
Right.
I think to the point that everybody here on the call is hearing, whether there's a certain situation is appropriate for you or not, you have to open the conversation with the entire team, right? So I know that's been a common theme we've mentioned, but each nuance, and then the changes. We're talking about the likelihood and what's the probability based on what we're all reading and seeing, and what's coming out of Washington. Right now, it's just immerse yourself in understanding that, and then as more information is divulged and as we start to get towards what things will be, I think that's when we start to take action. And this is our sort of final question. I want to again be thoughtful and make sure we have time for everyone to answer here, and think about anybody else who wants to ask one Q&A style, they're welcome to. So the nightmare scenarios. I remember, going through, especially within estate planning, what happens if you don't plan right? And usually it ends up with the government with a whole bunch of money and your heirs and others not having any. And it's just a complete backfiring of what early planning might have been that was done improperly. The same thing, Alex, I'm sure we could say about business planning and best intentions, just not necessarily planned properly. So I'll ask you, Charles and Courtney, to start this. Can you talk about a little bit the thoroughness of the planning and getting it right, and just how important it is, and what happens if you don't?
Oh boy.
I'll start kind of working backwards. From a state administration standpoint, when I started my career, I worked for the public administrator, and she took on a lot of large problem files. One file that I'll never forget was a very successful business owner, had very many business endeavors, very, very successful. His ultimate goal was he didn't want to pay taxes, right? And so his estate was riddled with tax audits. To Charles' point earlier, he had a lot of personal guarantees on business loans that all got pulled as soon as he passed away. So we were in foreclosures and everything else. And I think the only persons that won were the attorneys in that case. And so really that example circles back to everything that everyone has talked about, is that you have to read and understand what your business is. And that's really the only way that you're going to avoid the nightmare situation, because really the tax department will catch up with you. The IRS will catch up with you. The banks will catch up with you. Everyone will in an estate proceeding. You can be proactive and steer the boat while you are alive for your family, and try to circumvent whatever costs and expense that death will trigger.
Well, I guess the way I would look at it is that a business sale, whether it's going to take place during your lifetime or whether it's going to be prompted by a death, should be an orderly transition, and an orderly transition most of the time will optimize what it is that you're going to get as the capital from the disposition of the business. If you have chaos and you have conflict, what's going to end up happening is it really is actually a small world. And if you have a death and a business becomes imperiled because of fighting between the family members or otherwise, the rest of the world and the business community will find out about that. They know. And once that word gets out, then there's, I guess the old saying, now there's blood in the water, and then the sharks come out. And if people think that they're going to get the same price for a business in a situation where the blood is in the water and the business is perceived as being vulnerable, they're crazy, because it just doesn't work that way. What happens is the predators start to circle, they start nipping, banks get nervous, that adds a whole other element to things. And before you know it, rather than being able to have a great sale and making everybody happy, you end up having a fire sale or worse. So that's probably the worst case scenario, but unfortunately not an uncommon scenario. And that would probably be the poster child for advocating to people and business owners and families why they shouldn't do those things, and why they should cooperate, and why they should have a plan. Because otherwise, more likely than not, that's how it's going to turn out.
And don't assume, well, my kids get along, or I know they'll do the right thing, because unfortunately we have seen some really horror stories. Families that all got along, once mom and dad are gone, the gloves are off, and it's not pretty.
Or it is absolutely true that your kids actually do get along. It's the people to whom your children are married or live with or otherwise affiliated with who don't get
Mhm.
along, who are going to end up causing the problem.
You know, so much of that resonated professionally and personally. Um, but the one thing I did just want to pick up on the blood being in the water, two things. One is you put yourself up for sale, stuff happens, you stay in the market. It's just like having a house on the market. If it's been on the market for a year and a half, everybody knows there's something wrong with it and then it's overpriced. So that's definitely something to consider. But look, the fact is, and this certainly happened a lot over last year, is that businesses end up in a distressed situation with creditors, with any number of clients, any number of issues. And so that is the point where if you are in a fire sale situation, you really want to find a banker who has experience in restructuring or in distress, because they have relationships with the creditors, they know how to deal with forbearance issues and hopefully get you the best outcome or be able to convert debt into equity. Somebody also, and we do this as well, and it's something interesting that I think translates into kind of collaboration within the company, is someone who is used to dealing with a lot of parties who aren't that happy. Creditors aren't happy, equity holders aren't happy, management isn't happy. So figuring out how to work with all of those unhappy parties to get to the best possible outcome. And as you said, it happens more often than people may realize, but that is where that expertise is just so valuable.
Thought that was a great sort of question to end on from our comments. A few things. There were a couple questions that came into the hopper we weren't able to answer, and I know folks will watch this after. I know this will be available to be sent out to, clients of Hightower and other individuals. So if you have questions and you want to get an answer, whether it was answered live or not, talk to your financial advisor at Hightower. We're happy to. My team supports all of our advisors at Hightower from the Business Owner Services and Solutions team. So happy to bring Alex and her team onto a call, or Courtney or Charles, and help give you professionals in terms of having a further conversation. So please reach out to your advisor if there's any questions we can answer or take things a bit further. In 90 minutes, talking as quickly as we could, we didn't tackle as many things as we might have circled, but hopefully everybody here found this helpful. And got some good insight to take from today's discussion. So I'll end by thanking Alex, Courtney, Charles. Thank you all for being a part of this.
Very welcome.
For everyone watching.
Thank you.
Thank you all, everybody. Have a great day.
Bye.
Bye.